non-QM or a non-qualified mortgage is a home loan that's not required to meet the agency documentation requirements outlined in the consumer protection provisions of the Dodd-Frank Act. And what does that mean in English? Well, non-QM mortgages are not backed by Fannie, Freddie, FHA, or VA, right? These are loans that can sometimes have terms longer than 30 years. They may have interest-only payments associated with them. They may even have negative amortization, but that's not always the case. Many non-QM loans have very traditional terms and interest rates. Just the documentation required for approval is different. So to give you some quick examples, these are loans that may average income over 12 months instead of 24 months. They may use bank deposits to calculate income instead of pay stubs or tax returns. They may be what we call an asset utilization loan that allows us to use liquid assets to qualify the borrower. The list goes on, but real quick to give you some real world examples of borrowers that may benefit from these types of mortgages. These are W-2 borrowers that maybe have variable income, self-employed borrowers that may not have 2 years of business tax returns, investors that might not be able to show income, but they can show cash flow. Or borrowers with credit challenges, such as a recent bankruptcy or foreclosure. There's non-QM mortgages that can help them too.
Oh, that's great. So it's not back. It's not. We're not revisiting the crazy subprime days back in the mid 2000s. These are more refined, well-qualified borrowers who still are given the opportunity for a mortgage. I just want to make that clear. Is that correct, Matt?
Yeah, absolutely. One of the big things that I think differentiates these programs from subprime that we know from 10 or 15 years ago is these loans don't have prepayment penalties. That's a big difference between these and subprime loans.
Oh, that's great.